Welcome back. And today, I would like to touch on some things. And the things that I want to touch is on market distribution and accumulation phase. So, basically, what I always see, or the thing that I literally see every time when I go into the market, is there is distribution and accumulation phases, whereby the big banks want to distribute their orders and sometimes want to accumulate their orders. What happens is this: when they are accumulating, what they're doing, they're just taking longs. They're going longs. The position that they are opening is only longs. You get? So, according to me, that is a first factor you need to consider when going in, especially when you are a day trader, swing trader, any type of trader. You need to know when in the market, the market makers, they're accumulating or they're distributing their orders. The only way to identify this accumulation phase and this distribution phase is when the market, the price tend to stay in a consolidation. Basically, consolidation is when they are either distributing or accumulating. They only do that during an accumulation phase. So the first thing you need to identify is when they are accumulating. So in the only time frame you need to look at, because there is daily range, there is the sufficient daily range that you need to look at. Maybe gold, for some instance, usually trade around 1,000 to 2,000 p per day on a accumulation phase day. Tends to accumulate. Sometimes it also goes to 900 points or pips per day. In the day that the market has distributed or has accumulated, then we need to see big range, daily range. Okay, now the only way to identify is through the daily time frame or 4 hour. But I like the preciseness of the 4 hour time frame. So let us go there. Let us go to the 4 hour time frame. You can just literally choose any place you want to look at, but okay, we can go any point you want to look at. For example, you see here, this was sort of retracement, right? This was sort of retracement. Also in retracement, they are distributing or accumulating. Remember, the program is buys, but they need to come down. And the moment they are selling, they are selling in order to take longs. Okay, you know, if you're a trader, you can resonate with me that the moment the market is selling, they need to be an equivalent buy in order for them to close those orders that they sold earlier. So it is like a counter trading. It's like a counter trading. When you're opening buys, you need to sell that buy, and whenever you're selling, you need to buy it. It's like a counter trading part. So the moment they are selling, like literally at this point, from this area, like this price point, the high is 1.08375 until this low, this swing over here, the low, which is 1.08048. What basically was happening here is the market was selling, but in other sense, they need to buy for them to close all this. So they had to retrace so that they can go up. Okay, this is just the basic type of accumulation, but the one that I want to talk was the accumulation type. You see, like from this spot over here until this spot, when the market was just nothing but consolidation, it was going sideways, just coming down of the consolidation, going up, going down, going up. So this spot over here which is roughly how many candles? Let us see. How many bars are these? You can say right there. It's 64 bars. 64 bars. These are 64 bars times 4. So you can get the idea that I'm trying to push across. So these hours, the market was just accumulating buys. You know what? For them to go up, they need to take all these buys. And the moment they take these buys, it will be massive. I tell you for sure, it will be massive. You see? And the moment they do that, they come down to the equilibrium of the of the consolidation. You can see the consolidation is 972. So half of that will be 400 and 430. Let's say 430, 430, 430, right there. So they need to come down to the equilibrium of the consolidation, then take the market up. Then they take the market up. There are some factors to consider when they're taking the market up. They need to come down to a discount price when the market is at discount for them to buy. And after that, the market will rally up and do some phases along the way till it reaches the position that, oh, the spot that they were looking for. Now, in our case, you can see that the market shot up. The first one was here, did some little retracement, then take again the market rally up, then some consolidation. This is a sort of consolidation. Then the market rallied up. Okay. For now, we have a range of 2,232 points. That is roughly with 0.01. That is $22. $22. Now you can literally see the perspective I'm saying. So the market only does two phases. It is only distribution or accumulation. Then the market rallies up,